Hello and welcome to The Financial Dad, where I, your average young adult, ask my dad, your not-so-average financial advisor, all of my burning finance questions. And yes, this is my real dad. Let's talk a little bit about stocks.
Okay.
You said it's the most common, it's what I've heard of the most as well.
Most people.
So would you mind explaining what a stock really is?
Sure. A stock is ownership in a business.
Okay.
And if it's a public company stock, then it's an ownership in a company that has quote unquote gone public and that anyone in the public can buy shares of on a public stock market, like the New York Stock Exchange or the NASDAQ stock exchange, et cetera, or any of the stock exchanges around the world.
So then your payback, or that's probably the wrong term. So then your income off of that stock increases or decreases based on how well the company is doing.
It is in part based upon that. It could be in part based upon the industry the company is in. It could be in part based upon the market overall. We can talk about different kinds of investment risks, but the basic concept is the stock should move in relation to its performance, its profitability, its the outlook for it, etc.
Okay.
Correct.
Now within stocks, are there different things you can use to invest in stocks?
Yes, there are a couple of different ways to invest in stocks. You can buy the individual stocks themselves. So, think of any big name company you're familiar with. Generally speaking, that's a public company, and generally speaking, you could then invest right into that company.
Okay.
A second way to do it is through what's called a mutual fund. A mutual fund is just a pooled investment vehicle where people have put their money together and they have a common investment objective. Okay. And every day there's a professional manager, typically of that fund, who chooses which stocks within that objective to purchase on your behalf.
Okay.
Sometimes
so there might be a spread of a few different things within that.
There will be typically dozens of holdings within a mutual fund.
Okay.
There are two major benefits of a mutual fund versus just holding a stock. The first is professional management. You have someone
else making those
decisions,
experienced.
who's trained, experienced, and has a track record of doing this well, presumably anyway. I don't manage mutual funds. I can make fun of them all day. So, and the second thing is that you get diversification. You're not going to have 10 stocks that you might have that you would purchase yourself. They're going to have, 10 different stocks, let's say. You're going to have maybe 30, 40 different stocks that person has picked out. So you're reducing a couple of different risks by investing in a mutual fund, a pooled approach.
So if one company goes
just
down,
doing it on your own,
it won't affect as much of your investment.
Correct. I mean, if there's 30 companies and each company is about 3% in the portfolio, it could go to zero and you've only lost 3% of your money. But if you hold that stock and it's one of 5 that you hold, that's 20% of your money, let's say. So
it'll make a bigger difference.
Very, very, very.
And that's
much
called
different.
Diversification?
Diversification, correct.
Very useful.
Very important concept of investing and reducing risk in investments.
Now, beyond mutual funds, I've heard of something called ETFs. I'm wondering how that plays into stocks and investing in them.
Okay, well, it's similar to a mutual fund in certain ways, primarily that the money is pooled, with other people, okay? But an ETF, which means exchange traded fund, the ETF is something where it trades on an exchange and it trades all day long. You can buy it or sell it from the moment the stock market opens at 9:30 in the morning until the moment it closes at 4 o'clock in the afternoon. A mutual fund is only traded at 4 o'clock in the afternoon at the end of the day. So when you put in an order to buy or sell a mutual fund, you typically actually don't know at what price you're buying or selling the mutual fund because you don't know what the price will be at 4 o'clock.
Because it could change during the day.
Because it could change between the moment you put in that order and the end of the day. Because you have to put it in before the end of the day. Yeah.
Okay. Are there any other instruments of investing that are useful when it comes to stocks?
Well, the couple of other ones. Some people invest in stocks through hedge funds, which are professionally managed pooled vehicles like mutual funds.
Fund. Okay.
But this is something where somebody's probably taking greater risks and is using things like borrowing money to buy stocks, which can accelerate your returns and accelerate your losses. So it could be good, it could be bad, depending upon how things go. But usually these are professional managers who are used to these kinds of risks.
Okay.
Sometimes they make fabulous bets, and sometimes they make horrible bets. So you just don't know which one it will be. You hope it will be fabulous, obviously. Hedge funds, though, are typically larger investors. More wealthy investors are involved in those. A second way of doing it is through what are called puts and calls. These are options. Okay. They're called options. You can buy a call option on a stock, which is the right to purchase that stock at a certain price at some defined time in the future that has an end point to the time. Okay. So say you have a stock that's at $10, you could buy an option to purchase that stock at $12, and you pay some little bit of money for that. Now, if while you own that option and before it expires, means it terminates, in time, if the stock goes above $12, and at any time from that point until the end point, you can make money because you're above that $12 amount. So if it goes to say $15 at termination, you will have made $3 per share of stock on that, and hopefully you didn't pay more than $3 to get the option. Okay. But so a call is used, you buy a call if you think the stock will rise. Okay? You can also buy a put. And a put means you think the price of the stock will fall. And you can make money by buying a put if the price falls below the value of the put, basically. And you don't lose money, you make money. Instead of losing money on something going down in value. So what this does, these allow you to invest in stocks, but in a way designed for you to guess which way things are going to go, or to protect yourself in case something goes against you. So let's say you buy a stock, it's an aggressive stock, but you're also worried that it could go down in value just as much as it could go up. You might want to buy puts on it to just protect against as much of a loss as you might otherwise get. So those 50% losses, right? They come around.
That might have helped.
Certainly that would help if you had puts against some of that.
What does a typical expiration date for one of those look like?
They're usually within 18 months.
So it's a shorter.
But usually you're going to invest for probably no longer than 6 months. You're going to look for an option.
And that sort of thing.
Correct.
Got you.
Yep. By the way, you can also be on the other side. You can be the seller of a call or the seller of a put, not the buyer. And then you're in the exact opposite position
of the other one.
Yeah, you've taken in money. And if the bet is wrong by the other person, you get to keep that money. And you don't, so you've made money by selling the put or the call. So that would be something like, remember, we bought a call at $12. Well, if I sold that call at $12 for 3 months out, for the next 3 months, and if after 3 months the stock is still at $10, I just get to keep the money that I handed you, that you handed me rather, to buy that call. So I can make money, I can make income in a sense. There are risks to doing that, though. I don't want to get into it too much here, but there are some very serious
like a higher
risks.
Level
this is a higher level thing
for
there's a lot of math involved in it as to the valuation. And
I don't like
no math. No math. Hey, they said there'd be no math. So, there's actually a whole model of valuing options called the Black-Scholes model. And it's just, if you're not into calculus, don't bother. It's very complicated. So it is a way of investing in stocks and the stock market overall, but it can be much more speculative, or it can be a risk management tool, depending upon which way you use it. Right.
All right. So I feel like we've covered stocks pretty well. I want to dip the toe into bonds now. What is a bond?
A bond is a debt. If someone issues a bond, they're taking in money that they have to pay back later. So they owe you money if you're the investor in a bond. It's really pretty simple in that sense. Where it gets complicated is that, number one, if you loaned the money and own the bond, you can sell the bond to someone else. And you might sell it at the price that you got it for, or you might sell it for a price that's higher or lower.
So you can make money off of it.
You can make money on a bond, or you can lose money on a bond. The bond is a fixed income instrument, which means that the income that comes to you is fixed. You're going to get the same income no matter what happens until the principal is paid back on the bond, which is another feature of the bond. It has a maturity date.
Okay.
One day they're supposed to pay you back.
Okay.
And whoever issued the bond is giving you a guarantee that they're going to pay you back the principal and the interest, okay? So it differs from stocks in that it's not about the value of the company going up or down or sideways or whatever it does. It's about a guarantee made by the company or made by the governmental entity, let's say, okay?
Yeah.
That you are going to get your money back.
So let's say you invest in a bond you give money to the government, let's say.
Okay, yep.
And let's say it's for the purpose of a small or medium-sized savings fund for a child in the future.
Okay.
So you put in, let's say, like $10,000. What happens to that $10,000 over time? It's gone. It's in the government's hands. Like, you don't touch it, right? You don't get anything off of it until.
No, you do. You'll get interest off of it.
Oh, is that a regular?
It's fixed income. The income is an interest payment at a regular period of time.
So that comes to
several
you
times a year, let's say.
Versus coming due with the actual end of the bond. So
if it came due at the end of the bond, that would be sort of what's called a zero coupon bond. So that's a little deep into the weeds.
Okay.
But with most bonds, if you invest, say, $1,000, if it has a yield of 3%, you're going to get $30 a year. If it's a government bond, you're going to get paid every 6 months $15.
Okay, so
that's how it works.
So you make interest off of it regularly.
Correct.
While the debt is owed.
That's correct.
Okay.
They're paying you income. So it's typically
for your money.
It's typically more for people who need income as their investment goal, as opposed to people who are just looking for appreciation.
And
which
to
is what
one day take
typically
it out and just have a lot more money.
Correct.
Yeah.
Correct.
Okay. How would you say, how would you use instruments with bonds? Like different ways to invest in bonds?
It's actually pretty similar.
To stocks?
You can buy an actual bond, an individual bond. You can buy a mutual fund where bonds are the underlying holding. And you can buy an exchange-traded fund where bonds are the underlying holding.
Okay.
So any of those options is available to people to buy bonds. Puts and calls are really
more so
not so much used with bonds.
Okay. Well, let's move on. Are there any other asset classes that are important to know about how to trade within or how to invest in?
Well,
I should say?
I think for most of our viewers, that's going to be 90% of what they will deal with. You can invest in real estate through a limited partnership, let's say, instead of buying a piece of real estate. Most younger people are not going to be investing in that because it's illiquid. You can't get their money out anytime soon. It could be a very good investment. That's not what I'm saying. But most people are, not looking for something that's illiquid like that when they're fairly young. You can invest in gold, precious metals, through coins, for example. You can invest in it through mutual funds and ETFs also, exchange-traded funds. There are oil and gas investments, and you can invest in that through mutual funds and exchange-traded funds. So you can get into these other asset classes using pretty similar vehicles. There's another vehicle called a variable annuity, which can invest in these stock, bond, natural resources, commodities, asset classes, real estate. But a variable annuity is typically purchased for one of two other, or both of a couple other reasons. One is if you're trying to get some kind of a guaranteed death benefit for somebody. The second is if you're trying to get a guaranteed lifetime income for somebody. If you're trying to be sure that someone can't outlive their money. So usually someone who's approaching retirement or in retirement. The final one is tax deferral of money that's not inside of some kind of a retirement plan. Those are the reasons that people use a variable annuity. So short of that, variable annuities have a lot of expenses to them. Short of those kinds of reasons, there's not really a purpose to going into it. Correct.
Okay. Well, that wraps us up for the second part of our investments installments. Stay tuned and click on next for part 3. Thanks so much for watching this video. If you have any questions for us, feel free to reach us at our website and make sure to click on to the next.